Well, my task is to try to bring everything together, and I thought the way to do it would be to start thinking about what the real effects of bank failures are, because all of these papers are trying to address that issue. And you know, over the last 40 years, I think Ben Bernanke's dissertation was on bank failures in the Great Depression and what economic effects they had. Economists have been struggling with the following. We know that bank failures are associated with economic downturns. They're clustered in economic downturns. The question that economists have to ask is, do they add to those downturns? In other words, do they cause further economic damage, or are they just associated with an economic downturn? It's a critical public policy issue, because if it's just associated with an economic downturn, then we don't have to think too hard about the costs, the trade-offs between strict supervision on the one hand and lower economic activity. So the causation challenge is a daunting one for financial economists, and all of these papers are trying to identify a causal link in a very clever way, I think. The problem with identification is the following, okay? Bank failures are associated with economic downturns. You see it in a graph from Stefan's earlier paper that shows that when the economy does poorly, so do banks, and so do bank failures occur. We've seen a relative calm. We were getting over the hangover of the global financial crisis as late as 2013-14. And we see relatively few failures in the calm that followed, even though there was a large SVB failure. So the question then is, well, if you're going to think about real effects of bank failures, the first question you have to ask is, well, what causes a bank failure? Okay? And there's really two potential explanations from your earlier work. One is that they're bank runs. That was the case before the Federal Deposit Insurance Corporation. And what we worried about in bank runs was the following. Solvent banks would face a liquidity crisis. They'd have to sell their assets at fire sale prices, and that would cause further economic damage. Okay? We had deposit insurance, and deposit insurance led to greater supervisory oversight as a way of mitigating moral hazard. The second cause of bank failures, and I think is prominent, much more prominent in the post-deposit insurance era, is solvency. Poor fundamentals, such as credit risk, interest rate risk, and fraud, are what cause bank failures. Okay? And if that's the case, insolvent banks may not face runs, okay, due to deposit insurance, so you need supervisory intervention to close those solvent banks because zombies cause damage, as we all know. So what's the empirical evidence? Stefan has a paper that, to paraphrase Milton Friedman, our evidence suggests that the primary cause of bank failures is almost always and everywhere deterioration of bank solvency. Okay? Not a big surprise in an era in which you have federal safety nets. What that does suggest, however, is if it's bad fundamentals, then it should be predictable. Okay? And that is the case. This is a graph from one of your papers, Stefan, again, shamelessly borrowing from his research, where it's basically saying, okay, if I look at the things that cause bank failures, insolvency with low earnings, non-core funding, okay, non-core funding combined with insolvency, and then I add rapid asset growth in aggregate conditions, what do I see? Well, this is a graph that says, well, if I were just flipping a coin as to who to close, okay, it would be along that 45-degree green line. What you see, however, is that you can predict bank failures with these characteristics with a lot of precision. okay? What the graph shows is that about 86% of the time, 1 year out, you get a true positive using just fundamentals, okay? And you'd only make a mistake, false negatives, roughly 10% of the time, okay? That's important to keep in mind when you're thinking about supervisory oversight. One of the things I'd like to see in Stefan's paper is what is the incremental effect of supervision on this, because we have highly predictable bank failures, okay? So why worry about bank failures? I gave a paper recently to a bunch of non-banking academics on branch closures, and the first question I got is, who cares? Okay? You know, Barnes & Noble goes out of business all the time. Small businesses go out of time. So why do we care about bank failures? And the answer is, we think that they may have adverse effects on both the customers of the failed bank, and they have spillover effects, as Brian's paper suggests, and Stefan's work as well. In other words, it adversely affects the customers of solvent banks that are in the same market as the failed bank, okay? And that's a problem. So let me talk about each one of the papers real briefly, try to highlight their strengths and point out some additional work that might be done. The first paper, the Supervising Failed Banks, has really two parts to it. One is descriptive, which is what actions do supervisors take in response to poor financials? Do they take actions? I certainly hope so, because the financials are predictive of failures. So if they're predictive of failures, my gosh, I hope the supervisors can identify those and take actions upon them, because we can see them in the financial records of these institutions. The second part of the paper, I think, is far more interesting. Does increased supervisory scrutiny hasten bank failures? The answer is yes. And if so, what's the cost? Okay? Does strict supervision have a cost to it, or are we just getting rid of banks that would fail because they've taken exorbitant risks of fraud or made bad interest rate bets? The identification, and I have to compliment Stefan for the courage of going before a group of state bank supervisors and talking about the difference between federal and state examiners. But the idea here is that federal examiners may be more stringent. There's a random assignment at the start of the GFC based just on the timing of the prior examination. And you can then look at what stricter supervision implies. This is his table about the impact on bank failures, which is, I think, not terribly surprising that stricter supervision leads to more timely closure of banks, lower costs of the deposit insurance fund, and a higher probability of failure. What I think is really interesting about this paper is the table about what regulatory or supervisory strictness implies, which is in the local markets in which you have stricter supervision, okay, you see slower loan growth, slower real estate growth, slower C&I loan growth, more rapid branch closures, and reduction in bank employment. Now, what's encouraging to the strict regulators is the bottom panel, which is the effects are short-lived. In other words, there's not a lasting impact of stricter supervision on those key factors. Now, what I struggle with this paper, and it's not a criticism, it's an observation, and the authors are pretty upfront about this, is the findings pertain to GFS supervision, or global financial crisis supervision after the financial crisis, a period when there was a lot of unbooked losses that were a major problem with the banks, right? And so it isn't clear what the welfare costs are associated with stricter supervision in terms of deposit growth and lending, because we're talking about a lot of banks that had a lot of unbooked losses. okay? And then the question is, are you stopping gambling on resurrection with stricter supervision? And is more supervision and lower earnings implying a faster operational adjustments to a low-rate environment? Because what followed the great financial crisis was a very low-rate environment. And a low-rate environment put a lot of pressure on community banks because spreads were very narrow, okay? And that prompted operational changes, okay, as you're all aware. You got to push people off onto a different platform if you're in a low-rate environment. The second paper, Depositor Attention and the Cost of Funding, this paper's contribution is to say, well, there's another spillover effect that we ought to think about. And that other spillover effect is when you have a bank failure, okay, what happens to the rates that banks in that same market have to pay? They go up. And deposit growth declines, which means there's a shift away from deposits. Okay? That's a negative externality, what we call in economics. And it has real effects if those deposits lead to, as they do, slower loan growth. Okay? And particularly amongst small businesses. And what the authors are pretty clever in doing is disentangling the mechanism, which is depositor attention, as opposed to solvency concerns. So one of the issues with all these papers on bank failures is they tend to be clustered at periods of slow economic growth, and in particular, the global financial crisis occurred at a time that was subsequent to or preceded a period of very, very low interest rates. And then the question is, did that lead banks to close branches? Did branch closures lead to the kind of real effects that we're talking about? So is it the failure of the bank or the low interest rates that led to closures of branches that led to declines in economic activity? And so is the mechanism saliency or infrastructure changes? A couple of other comments. First is the focus is on really large CDs and 100,000, 500,000, which is a small portion of the funding of most community banks, okay? And it tends to not be localized funding. It tends to be out-of-market funding, okay? The other thing that is a little tricky here is when the FDIC takes over a bank and the acquirer assumes the deposits, if they're insured, in a time deposit, the acquirer tends to continue to pay the rate on those assumed deposits. Which means that if the failed banks were paying higher rates, okay, you're going to see higher rates almost mechanically at the $100,000 mark, which is why I think the impact, maybe one reason why the impact on deposit rates is greater for the $100,000 than the $500,000. The other reason may be just the difference in platform. You're not picking up $500,000 CDs, okay, in the local market at a small branch. Okay? The final paper, Bad Luck, or Bad Banks, Bad Luck, I think is a really fascinating study. And the reason, as an economist, I'm fascinated by this study is what we don't have in the United States that Europe and Asian countries have is a credit registry. So that you can track borrowers and lenders throughout the system. Okay, we don't have that here. Okay, what they've done is really a quite clever way of coming up with a credit registry. Okay, so one of the pitches would be, let's have a credit registry. Okay, so the interesting thing about this paper, again, not only the data, but the basic idea behind the FDIC's closure policy is we want to mitigate the disruption associated with the transfer of banks' assets. okay, the liquidation of those assets, by transferring them, the good assets, to an acquiring bank and the deposits to an acquiring bank. That's the whole idea. So to find, okay, real effects on bank customers, for particularly small business customers of these banks, when most of the P&A failures are treated with as a P&A transaction, is somewhat surprising. So it's an amazing database. The contribution is a lot of new evidence about persistent adverse impacts of bank failures. This graph shows the effect. It's mostly in the first 5 years, okay, which strikes me as surprising that it's so long lasting. So then the question becomes, and I have to say this because I'm an economist, and when economists talk about papers, they have to think, well, what else is going on? Okay? And what comes to mind is reverse causality. Okay? It's not that the failure is causing the decline in, or the increase in business failure rates, or causing declines in unemployment, but they're a reflection of the fact that the insolvent bank had made bad loans. Okay? So it has worse customers. Worse customers are more likely to fail, okay, and have slow employment growth, particularly in the period of time that's the focus of the paper, which is in the post-GFC time period. Now, one of the things that I think makes the reverse causality argument plausible is something about bank culture, okay? Which is that when you look at material loss reviews, what do they say? They say the bank failed for a variety of reasons. They'll pinpoint one or two, such as, oh, you made bad construction and development loans, or you had a large portfolio of other underwater mortgages. But they also typically say something about deficiency in underwriting, credit administration, risk analysis, and recognition. It's a culture problem, okay? If it's a culture problem, then a couple of things come to mind. If it's a culture problem, then it's not just one part of the portfolio that might be performing poorly of a failed bank, but it would be all parts of the portfolio. Not just the small business loans, but the larger commercial loans, the real estate loans, and the like. Okay? There's a couple of interesting papers that I'll summarize here. One is, if you look back at banks' performance in 1998 during the Asian financial crisis, and ask the banks that performed poorly during that period performed poorly during the global financial crisis, the answer is yes. Okay? There's a recidivism rate in culture. Second, there's this boom and bust paper in small bank business lending, which is really interesting, because what they do is they say during boom periods, banks that are flush with deposits tend to reach out and lend to small businesses at further distances. Okay? And if you're lending at further distances, you're not getting that relationship with that customer. And what do we observe? We observe higher default rates for distant loans to small business borrowers. Okay? So where do you see that? You see banks whose branches were in primarily high growth areas reaching further and further. I know I'm over. What does that tell me? Well, it tells me failed banks are likely to have large asset growth. Large asset growth may be in high deposit markets. I might be reaching for small businesses at longer distances. What Yannick might say is, well, maybe it works in reverse. The bank fails, the branch closes, and the acquirer says, you know, it's now further from my market, so it looks like a riskier loan. I don't want to make it, okay? Which then leads to the failure of those, a higher failure rate for those customers. So again, to look at the selection, I might look at lending at bigger, longer distances. So just to summarize and then open up for comments and questions, this is a great set of papers. From an economist's point of view, and hopefully from a community banker's point of view, what's neat about these papers is they have very clever ways of trying to tease out causal links, which I think is really important. What I think is needed, and Stefan mentioned this, and I would reinforce this, is they do provide evidence of a trade-off, okay? Stricter supervision, slower growth, okay? But the question we need to ask is, what's the cost of not taking action? Do the zombies cause more harm than prompt corrective action? And unfortunately, we don't have good empirical evidence to guide us on that. Okay. So with that, I'll open it up to questions or comments from the panel.